In the high-stakes world of healthcare startups, particularly in biotechnology, securing venture capital is often the make-or-break moment for a fledgling company. But what's equally critical, yet too frequently misunderstood, is the term sheet, the document that outlines the legal and financial relationship between startup founders and their investors. While it may seem like a formality in the process of raising capital, the term sheet is actually one of the most defining and enduring agreements in a startup's life. And understanding its structure is essential for any entrepreneur in the biomedical field. Unlike many sectors where founders can operate with agility and iterate rapidly, biotech is slow moving and capital intensive, often requiring multiple rounds of financing before even reaching clinical validation. The term sheet not only reflects the initial valuation of the company and the size of the investment, but also embeds strategic terms that determine how control, risk, and reward will be distributed over the company's life cycle. According to Rasit Dinc in Chapter 7 of Navigating the Business Side of Biomedicine and Biotechnology, failing to fully comprehend a term sheet can have devastating consequences. It's not uncommon for scientific founders, brilliant in the lab but less familiar with financial mechanics, to unknowingly agree to terms that later restrict their ability to steer the company or participate meaningfully in the upside if and when success finally arrives. One of the most fundamental concepts in a term sheet is valuation, which defines the company's worth before and after investment. A low valuation can mean greater dilution for the founder, while a high one, if not justifiable, may deter future investors or lead to damaging down rounds. The ownership percentage that the investor will receive is tied directly to this valuation, and it's essential for founders to understand how their own equity stake will change following each capital raise. Another critical feature of the term sheet is liquidation preference, which defines the order in which stakeholders get paid if the company is sold or liquidated.
A one-time liquidation preference means the investor gets their money back before anyone else, while higher multiples or participating preferences can significantly reduce what remains for the founder. These clauses can seem innocuous but have enormous implications in moderate exit scenarios. Equally vital are anti-dilution provisions, designed to protect the investor from future financing rounds at lower valuations. While full ratchet protection can severely penalize founders, weighted average mechanisms offer a more balanced approach, but both should be scrutinized closely. Then there is board composition, often overlooked until it's too late. If investors are granted too many board seats, founders can lose strategic control. In biotech, where pivots are rare and product development follows a highly structured path, board control can shape everything from trial design to licensing deals and exit timing. The vesting schedule is another key term, especially for founders who expect to maintain long-term influence. Investors often require that founders revest their equity over a 4-year period to ensure commitment, but the specific clauses around acceleration, triggered by acquisition or termination, can vary and impact founder incentives. Drag-along rights, which force minority shareholders to go along with majority decisions, can expedite exits but also silence founder dissent in key moments. The term sheet also includes information rights, which give investors access to financials and updates. While routine, these rights should not be overly expansive, especially in early stages, where excessive reporting can burden the startup team. In biotech, where timelines are already long and unpredictable, these demands can create additional operational strain. Another layer of complexity arises with protective provisions, which give investors veto power over certain decisions like issuing new shares, changing the company's charter, or approving a sale. These provisions effectively give minority investors significant leverage, and if misaligned with founder interests, they can paralyze strategic direction. One of the more delicate aspects of term sheets is the no-shop clause, which prevents founders from seeking alternative offers once a term sheet is signed. While common, the duration and scope of this clause should be reasonable, especially in competitive funding environments. Also, the exclusivity window, the time during which the term sheet must be accepted, can pressure founders into rushed decisions, making legal counsel not just advisable but essential. According to Dinc, biotech founders should never engage with a term sheet without experienced legal representation. The nuances of terms like participating preferred stock, pay-to-play provisions, or conversion rights are complex and can shift the economics of a deal substantially. Moreover, these negotiations often take place under emotional strain. The promise of funding is intoxicating, and the fear of losing the deal can cause founders to concede too much, too fast. But walking away from a bad deal is often better than entering a partnership that hinders future growth or undermines mission alignment. It's also crucial to remember that the term sheet is only the beginning. Once agreed upon, its terms are typically expanded into a series of definitive agreements, including the stock purchase agreement, investor rights agreement, and voting agreement, all of which bind the company legally. Founders should ensure that the spirit of the term sheet is preserved through this legal documentation. Many assume that term sheets are non-binding, which is only partly true. While the economic terms may not be legally enforceable, provisions like confidentiality, exclusivity, and governing law often are. Furthermore, as Dinc emphasizes, the biotech sector is unique in that it sometimes demands more transparency from investors than other sectors. While most VCs refuse to sign NDAs, biotech is the rare exception due to the sensitivity of preclinical data and unpublished research. Founders should understand this norm and ensure their proprietary information is disclosed strategically, often with the help of seasoned advisors.